At the end of last week, we had a massive run up in the market, but this week we've kind of stalled out a little bit and hit some overhead resistance. Riz and I are going to talk about what to expect in the market this week. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our weekly market recap webinar. My name is Chris. I'm part of Riz International, and we are a group of traders who are looking to try and make our money work for us and not the other way around. And if that's something you're interested in, make sure you smash that like and subscribe button. Click the bell icon right next to it to make sure you get notified every time we upload a new video here on the channel, because tonight we have a very special guest. The man himself, Riz Memon, is here. How you doing, Riz?
Doing good, Chris. Yourself?
I am doing great. I'm so glad that you're back. Of course, we've been thinking about you these last couple weeks since you've been taking a little bit of a break from the webinars, but we're glad to have you back on. And man, it has been quite the story to tell these last few weeks. Obviously, we finally busted through 4,200 here, but this week we could not break 4,300. The market just would not push over higher, and for the most part, just traded sideways all week. We really kind of were stuck below 4,300 and like right around this 4,260 area, and really just kind of bounced around. And even though it looked like on Friday we were making a real strong push, at the end of the day we had this huge selling pressure that pushed us down back below 4,300. Now, obviously we have some big things coming up this week, primarily the rate announcement, the interest rate announcement. And I know that a lot of people are thinking that the Fed is going to pause, but as this is a major catalyst, I feel like that's a little bit premature in my opinion as far as the Fed pausing interest rates. I really think that they're not ready to do that. That's just my opinion, and of course I'm not here to give you financial advice, but Riz, what do you think has been going on with the market lately? Obviously it's been really difficult to trade, but we just can't seem to breach 4,300 at all.
Yeah, so we had some consolidation this week, but the week prior, we had that big run up. And if from a really technical standpoint, for the people that are a lot more interested in just technical setups, this is pretty much like a bull flag if you think about it. It's a classical bull flag. In fact, the S&P 500, even from a statistic standpoint, is actually up over 20% from the lows, and that is a technical bull market now. So, Chris, if we go, I think in October, it was the lows there. Compared to now, it's over 20%. The index has moved up over 20%, 23%. So we are now in a technical bull market again. It doesn't mean it's going to sustain, or it has to sustain just because it's over 20%. That's kind of arbitrary. I'm not saying it's going to happen, but if the market drops another, let's say 3%, 4%, are we back in a bear market? Is it still a bull market? That's where it gets tricky, right? The interpretation gets tricky. So being able to sustain this is the most important part. Touching above that 20% isn't the most important thing. It's about holding it and being above it and essentially reaching new highs. Now, we have done that. We did do that this week till Friday came along. So we did throughout the day, especially early morning, for those that were watching on Friday, did go above 4,300, pretty bullish, and then during the close, kind of gave back all the gains and closed just a smidget below 4,300 at 42.98. So that 4,300 is a key resistance level. As you can see, Chris has that red line there already, and that resistance was last touched on in August of 2022. So it's quite a strong one there. And in fact, there's quite a few touch points even further back in May 2022, I believe, as well. So it's something to keep an eye on. March 2022. So it's something to keep an eye on. We will see how it goes, but this has been a tremendous run up from October to now. Even that little dip that we saw at 3,800 in March of this year was the year's low for this year. So for those that kind of got in or kind of started scaling in to individual stocks, high quality ones, especially tech, and if they're kind of carrying, well, they're doing really good. as the market's breached above those three moving averages there. So from a technical standpoint, the market's definitely looking very bullish, a lot of momentum. Obviously, I and some of you in Elite obviously have some positions open, long positions. So let's see how that shakes out. But still, I do have that sizable component of cash. But contrary to belief, people always think, well, Riz, if you're in cash and you're missing out on the rally, you're missing out. Well, not completely, because I can generate a return on that cash via specific options methods, like the wrapper method, so on and so forth, right? So it's not like I need to be fully vested to be fully invested to be able to have a return. I could technically still generate a return on my cash, uh, not including interest, but actually via option strategies. So that's something to keep in mind for those of you wondering, well, Riz, you're too much in cash or you missed this rally. Uh, Not quite. It's give and take, right? And that cash is a way I effectively hedge. I mean, it's really the best way to hedge in your trading account. Um, because especially in an environment like this where we aren't out of the woods yet from a macro standpoint, which we will touch on once we kind of go over the economic data for the week.
Yeah, definitely some big numbers being reported here, and we'll touch on that in a second. But Riz mentioned tech, and obviously tech has just been steamrolling here as of late. Ever since, I'd say about late May, has just been on an absolute tear, up almost 35% on the year. Compared to the S&P 500, which is currently up about 11.85%. So, really kind of making a big move there compared to the S&P 500. But look at consumer discretionary here since, again, about May, just going crazy. People really putting some money and getting into those stocks that are, would be considered discretionary. So not your staples like, food and things like that, but things that maybe you don't necessarily need to get by. Now that being said, everything else is underperforming. Of course, communications is right there with tech, but everything is underperforming the S&P 500 right now. Real estate just broke over the zero mark this week and is holding at 0.13%. But we look at consumer staples, financials, energy, healthcare, utilities, all down below the zero line, severely underperforming the S&P 500. And I feel like a bit of a broken record, but I mean, it's like these three sectors are propping up the market right now. And if we see a big pullback in any of those, it's not going to be, good news for the market. Riz, is this type of a move sustainable? I mean, can we continue to, push higher with just these three sectors, or are we looking, at possibly a pullback at some point?
Yeah, it's not sustainable. This the What we call the market breadth is very, very minimal. So the rally in the S&P 500 is predominantly derived from these large tech stocks, which fit into the XLK tech sector, but also the communication sector. So Google, Apple, Netflix, some of these companies actually fall into the communication, but overall, these are the large gainers. These are the large gainers. Google, Microsoft, Apple, we've got Nvidia, we've got Tesla even, they're really, really pushing up the market. Whereas you have the other, constituents of the S&P 500 index, the other, let's say 450, 470 other stocks, apart from the top 20, top 30, they're all like lagging, and they haven't been quote unquote participating in this rally. So the index is up, but many of these stocks are kind of languishing. Contrary to what happened last year, where it's a stark reminder that what was leading last year doesn't lead the year after, and that is energy. Last year, energy stayed the entire year above the S&P 500, like how tech is looking right now. Energy looked like that with 30, 40, 50% on the year. Remember that, Chris? Last year we would be looking
Oh
at
yeah.
it. Oh yeah, energy is the big thing. Energy is just running. Energy is, and it did, but look at where it is now, right? So it's a common misconception that people would pile into different sectors because they're doing so well, uh, assuming that it's going to continue to do well. That's the classical, beginner herd mistake. So I always say what's leading today may not be doing so tomorrow, and I think that applies to life as well. You really got to earn your keep, so to speak, and not surprising at all when it comes to some of these sectors like utilities, uh, energy and financials and consumer staples underperforming. But if we do see a pullback in tech, communications, and kind of consumer discretionary, some of will obviously will be held in cash. Some of it might go into like treasuries, bonds, but a portion of it will also go into other sectors. So that's what we call sector rotation. So that's going to go into things like maybe consumer staples, right? Consumer staples companies, to give you an example, would be, think of it like, Johnson and Johnson, right? Pharmaceuticals, like Merck, like Pfizer, all these kinds, money will go into these utilities companies. There's many there. Obviously, some of the financial money might go into them, but they're a little bit of black sheep this year with all the banking, especially the regional bank fiascos that we've seen in the U.S. So we're going to see some money rotate into other things. So it's not going to be completely one-to-one where if tech goes down and all these other companies go down too, other sectors, sorry. They may if we see a really big kind of market panic or freak out, but usually we do sector rotations. We do see sector rotations in healthy bull markets and even bear markets, we see sector rotation. So if we do see a pullback in the top three performers sector-wise, yeah, we could see a little bit of a pickup in the others, which I think is what's going to happen. As far as a hard timeline, well, that's anyone's guess. But really, I do feel like we are in due for a pullback. When we do flip over to the S&P 500 chart later on in the webinar, you'll be able to see that the market is kind of getting very overbought, overextended on a daily chart, and that usually doesn't bode too well. Again, it's not a guarantee of a pullback, but it doesn't bode too well for the market when we get very extended.
Absolutely, and one of these markets, and we mentioned energy. Obviously, energy was running high last year when we had all these spikes in oil, but now oil, like you said, kind of languishing here. I feel like we haven't talked about oil much at all because there's not much to talk about. We're just hanging out here. Where did we close on Friday? Right around $70 per barrel for light crude. Now, I heard a bunch of talk about the Saudis saying they were going to cut production 1 million barrels per day to try and push this price back up. But if that's the case, it doesn't seem like it's working so far. And then gold is more of the same from last week. We pushed back down below this $2,000 per ounce line, and we kind of had a very bearish push on gold, and now we're really just kind of consolidating right below this 1967 resistance area that has been held several times prior. But Riz, what's going on with oil and oil production? Because we see the price of oil just kind of hanging out here, but yet the price at the pump kind of is creeping up a little bit, at least on my end. I don't know what everybody else is where they're living. Mention down in the comments what you're seeing as far as the price of regular gasoline. But Riz, give us some insights on that.
Yeah, so I can shed some light on the gas prices, obviously being in the industry for, oh God, I don't know, maybe 10, 12 years now. Um, I can say easily that although the price per barrel is down, the gas prices at the pump are up for a couple of reasons. One, we're in summer season. Seasonality is very real in the gasoline market at the pumps where we are seeing more demand. Obviously, more people traveling, more people doing road trips, more buying, more commuting. So that's one of the reasons. And the retail side and the producers are making more money because of it. So because prices are at the rack, sorry, on the markets, $70 per barrel for WTI light crude, that doesn't mean that those companies are paying $70. They're hedged, right? So that's something to keep in mind. This is the current, real-time price as of Friday, but it doesn't mean things like Exxon or Chevron are paying $70 per barrel. No, their cost could be higher. Their hedge could be they could have it hedged at 75. They could have it hedged at 60, right? So it's not quite one to one. And obviously, you got to have profit margins at a gas station. You got to pay employees. You got to pay for the lights on to keep the lights on. You got to pay property tax, whatever. So those are costs involved too. There's obviously tax. Many people forget that there's actually tax already in the price at the pump, right? So I don't know about everyone in the States or now internationally, but in Canada, it's just as usual. Taxes on gas went up. And they're kind of like a stealth tax because it already goes into the price at the pump that you see. So it's not necessarily because people are trying to rip someone off or whatnot. Just taxes are higher. There's already taxes in, and then costs are higher, and of course you're in the demand season. So those are one of the reasons where we see that disconnect, where prices are either holding up or higher at the pump, even though barrel price is actually a little bit lower and trending lower, as you can see. So hopefully that gives some clarification. Gold, I really don't have much to say. Quite boring, yawn. Not
Hmm.
something I'm too interested in. But oil, yes, this is something I'm keeping an eye on, that 70 mark. I do think if we go below maybe 60, 65, I think that might be an opportunity to consider long. I know I've said before on these kinds of projections where I say, okay, I might take a long position if it goes here, or I might, take a short if it goes here. And sometimes it does go there, but sometimes I may not take a trade because of what I'm seeing in price action, right? So there's always reasons, even if I have a plan, and when the time comes, I'm not one of those people that, oh, okay, this ABC happens, then I'm going to do, X, Y, Z. Not necessarily, because I'm completely discretionary. I have a lot of experience in the oil market from a trading standpoint, but also from a business and operations standpoint. So I always look at it from a multi-pronged approach. And even though if I say right now, like let's say oil gets to 65 and I'm like, I might want to go long at 65, but what if it gets to 65 this coming week? And then because of the price action I see, I might still not buy because I feel like maybe it could go a little bit lower, right? Um,
Yep.
that's a decision I make in that moment. And again, that might not be to everyone's style, but that's the way I approach it. As far as what's going on, bigger geopolitically macro, yes, Saudi is definitely wanting to kind of corner the market a little bit. Of course, they're part of OPEC plus, the plus being Russia, and yeah, they're a little bit upset with the U.S. Kind of relations have kind of gone down between the two countries, for better or worse. Depending on whatever your stance is. So yeah, they're trying to raise prices. Their economy is very much dependent on having a very uh, set price on oil. Obviously, higher the better is for them, but it needs to be balanced between demand and supply. And for them, they feel like we want it a little bit higher. Maybe I'm guessing they want it above 80. Uh, but the current administration has a way of combating that, and that is in the SPR, the Petroleum Reserve um, that the U.S. has. So the U.S. has millions and millions of barrels usually that they keep in reserve for emergencies or something happens. But what the current administration has been doing over the last year, year and a half, is they've been releasing barrels of oil from that reserve and putting it into the market to bring prices down. Remember, increasing supply, right? This is a lesson 101 in supply and demand. So the administration is taking out my oil barrel from this reserve, this big tanker that they have, just sitting there for emergencies, and giving it out to suppliers, because that puts downward pressure on the price. Why are they doing that? Because obviously oil prices have been a big talking point at the pump, especially last year, with prices being so high, with inflation. You know, so they were incentivized to kind of bring prices down. Um, Now, eventually, they're going to have to buy back those barrels to refill the SPR, refill that reserve, right? If prices go down further and they refill it, that could effectively act as a little bit of a floor. Um, but it depends on how they go about it. So that's something to keep in mind too. That's something we never had to deal with. We always had to deal with OPEC. We always had to deal with demand. What's the season like? What's price per barrel? But we never had to deal up until last year with, oh, okay, what's the special petroleum reserve going to be? What's the barrels out? When are they selling? How much are they selling? How are they going to buy back? So really, if you want to think about it at a high level, the the administration is effectively trading oil and impacting supply and demand, right? Not necessarily trying to make money, but to effectively decrease prices. and stabilize gas prices lower for the populace.
Yeah, we got a couple of our elite members here chiming in on the webinar. Michael is saying it's around $2 a liter in Vancouver. Remember, that's per liter, not per gallon. Big difference there. So that'll probably be closer to four plus dollars per gallon if you're using the imperial system. Oz says that depends on the city. In LA, it's $5+ per gallon. Ouch. And then if you're on the coast, it's more about 420. And then Jeff coming in with the lowest at 308 per gallon in Colorado. So yeah, I guess I need to move out to Colorado. Heard it's beautiful out there, and apparently the gas prices are beautiful too. Let's take a look here at the bond yields. We've been kind of on a bit of a run here lately with the 2-year bonds really kind of ratcheting up a little bit, closing at 4.6% on Friday. So a very big, strong move on there. While the 30-year and the 10-year are just kind of lagging, not getting as big of a push as the 2 years. And the dollar really kind of just hanging out, kind of like gold almost, really not doing too much. After we had a bit of a run here at the start of May, we really just kind of hanging around this 104, 103 area. So, Riz, what's pushing these bond yields up so much as of late?
Yeah, simply put, speculation and perception that we're going to see rates go up a little bit. So the bond market is thinking, okay, maybe we're going to see uh, this next Fed meeting rates going up, and we'll touch on that in a bit. But ultimately, yes, the market, depending on what analysts you speak to, what data points you look at, it's going to be a little bit of a variance, but overall, there is an increased uptick in chances of the Fed raising rates by 0.25% this Wednesday. And the odds were lower if we can look back 2 to 3 weeks. Now, what changed that is positive and strong economic data. So we're talking unemployment, uh, what's it called, jobs growth, we're talking new job openings. All these things are very strong, very healthy, and because of that, it's keeping the economy relatively overheated. Yeah, inflation's down from last year's 9 something percent, but it's still high. It's still above the norm of 2 to 3%. So it's not like we're all in the clear from an inflation standpoint, but you need to slow down the economy. And when the economy is not slowing down, the Fed really doesn't have any more choice besides increasing a little bit more. And in fact, we saw that this past Wednesday with the Bank of Canada. They had paused, the last meeting they did a couple months ago was they paused rates. But this one, and people were thinking, okay, that's it. They paused and they're going to pause for the rest of the year. But because Canadian GDP came in very strong, and the economy is actually quite strong in Canada here. So they had to step in and actually increase the rates again this Wednesday by 0.25%. So you can see how what people perceive to be, the case for what to come for the rest of the year may not line up, depending on who you follow and who you speak with. So it's important to always look at it from, as a moving goalpost. As I say, it's hard to, come up with a thesis and say this is exactly what's going to happen by the year end. I think that's bogus. I think that's just wishful thinking. So it's important to really understand that this is always a moving barometer. The economy, consumer spending, consumer confidence, obviously markets, everything. So I feel like there are high chances that the Fed does raise by 0.25%, but again, we will never know until the day of.
No, that's a good point, and let's go ahead and talk about those dates because we got some big dates coming up this week. As Riz was talking about, inflation numbers coming in, the core inflation rate year on year, and rate month on month are coming in on Tuesday before the market opens, and then Wednesday is the big day. We got the PPI and then the federal interest rate decision. That's the big one. The Fed is making their call. Obviously, it looks like the consensus is that they're going to pause, but I think that that's a little bit premature, in my opinion. I'm with Riz on this one. And then Thursday, we've got retail sales month on month as well, so that'll be another good indicator of how hot the economy is. and it looks like they are thinking that it's going to be lower than it was before quite a bit. So that will be interesting to see. But yeah, I mean, Riz, you kind of already talked on it, but I can't see the Fed stopping interest rates just yet because, as we've talked about multiple times, their whole goal is to try and cool the economy off, and the economy just keeps on steamrolling at this point. So I just have a hard time believing that they're going to pause, but I know that some people believe that is going to happen.
Yeah, you're right. Definitely both sides of the camp. And right now, I can't fault either side because we're really at that precipice. Are we at that so-called pivot where, is the Fed going to pivot? Everyone's been waiting on that, yada, yada. And we've spoken about this over the last few months throughout the year. But again, because the data is showing what it is, I do think they might be more inclined to raise once more. Then I think the odds of pausing are actually higher in the next meeting. If they don't raise this Wednesday, I think the odds of staying of increasing in the next one it stay elevated, right? So I don't know if that makes sense, but ultimately that's really the case. If they raise now, then the odds of an increase again is obviously going to dissipate. There's not going to be much odds that they're going to do another 25 basis points. There's always that case, but the odds are going to go down. Whereas if they don't increase now, well, those odds are going to stay up there. So I do think we are in at some point, either this meeting or the next meeting, for an increase. Again, inflation rate will kind of factor that in, but the Fed already has those numbers already. Leading into Wednesday. Although they are released for us on Tuesday morning, the Fed already has these numbers, preliminary numbers, leading up to the meeting. So they will base their decision not only on inflation, but they base their decision on employment. They base their decisions on uh, PPI. They base their decisions on jobs numbers and job growth as well. Even average wages as well.
Absolutely. No, I like that concept you have there. It's like, if they do pause, they try and pull a Canada on us and, pause for 1 month and then raise the next. That could definitely pull, throw people for a bit of a loop. I want to go ahead and if you are here live on the webinar and you do have questions for Riz or myself, start posting them in the chat now. But since Riz was talking about it earlier, the S&P 500 being a bit extended, I have to agree with you from a technical standpoint. I mean, we're a good uh, what a good 150 points off of the lowest moving average here, which is going to be the 10, if I'm not mistaken. Nope, the 50, excuse me. And so, quite a bit of space there. And I don't know, Riz, you can tell me your thoughts on this. Do you feel like the market is pricing in a rate pause here? Is that why we're seeing this bullish move here over the last couple weeks? Or do you think that that's already priced in at this price?
I think it's priced in. Again, I can be wrong, and then this is one of those things that's very objective, person to person. It's very hard to say for this one, but I think it's priced in. What the market's running on is the fact that inflation will be down near 3.5% by the end of the year. That's what the market's pricing in. The market's also pricing in that we get a soft landing or maybe no recession.
Hmm.
You can see how it's kind of really shifted from start of the year and even last year, end of last year, to where we are now, which is last year, the worry was, okay, we're going to get a hard landing, we're going to get a hard recession, we're going to have inflation rates stay high above the norm for much, much longer than anticipated. But that narrative has shifted, and the data has obviously shifted as well to support that because we have seen GDP be positive for the last 2 quarters. We have seen inflation come down, and we have obviously seen a resilient workforce, a resilient economy. Uh, so it's kind of a mixed bag. I do feel like we do see a rate hike, like I've said, but again, it could really go either way. It's one of those things that's very contentious. And as you mentioned, from a technical standpoint, Chris, you could see the RSI getting really up there near the 70 area overbought. And I will also point out to the last time that we really had a actual hit of that 70 overbought area was in February, as Chris has also circled right here. And guess what? That lines up with kind of that kind of peak before that drop from 4,200 down to the 3,800. So that's some A++ technical analysis and look back for you to contextualize the RSI and what's happened. Now, I'm not saying it's going to play out exactly like that, but it's something to keep in mind. There's that 4,200 zone as well, right? Obviously, we've broken past that strongly. We're now actually near the 4,300, but that 4,200 is now going to act as support if we do see a little bit of a pullback. So that's another 100 points if we do see it. Again, if we break below that, as Chris is drawing now, it's going to be a bit of a timber situation where a strong break below, I can assure you, will lead us lower to 4,150 and potentially 4,100, which happens to be that consolidation zone we got for the last 2 months, and it felt like 2 years, to be honest. But hey, people that are looking at this and are savvy and will say, Rich, look, we had a strong consolidation for 2, 3 months. This breakout is because of that consolidation, and we know for those that have been paying attention, especially to the masterclass, know that the longer the consolidation, the more fast and furious the move that precedes it. And this move that we've had, this run up in June and end of May, is that move that precedes a long consolidation. So this rally could have legs from a technical standpoint. Okay, that's another way to interpret it. So really, I want you to be thinking of it from this way, not you, Chris, but the listener here, where we look at different things and we piece them together and we look at it from a probability standpoint. We don't just look at, oh, this is a bear bull flag to the moon, or oh, Powell's going to come in and crash the market, or no, oh, Powell's going to come in and pump the market. No, it's not only these things. There's so many factors at play. It'll be interesting to see also if GDP comes in the next couple months for Q2 as well. So a lot happening, especially this week. Fingers crossed. It's going to be a busy week. We've had a decent week. It's relatively slow but profitable week this week for us in Elite. It's actually been I'm not going to lie, a phenomenal year from a trading standpoint, from a profitability standpoint, from a trading standpoint. The team has killed it. Again, kudos to the team. Kudos to everyone in Elite. Again, I don't want to blow smoke or air up anyone's rear, but really it's been an amazing trading year from a performance standpoint for not only myself but the team and of course our members. So really happy with that. Really pleased with that. But I think the exciting stuff is to come in the later half of this year, where we now have to pivot and react to what's going to come. We've got the rally, we've got the push forward, we've got the momentum. But now what? Now the market's going to start looking past some of these things we've already factored in. We've factored in the debt ceiling. We've factored in, all the other stuff which has happened. Like inflation for the most part is factored in. The market's already expecting 3.5%, 4% for inflation to come down. If something happened by the end of the year where it's still above 5%, well, then the market's going to react, right? So that's my take.
Awesome. Thank you for sharing that. All right. Larry came in first and he said, can we take a look at the whole ADA thing and others now being considered a security and discuss what our thoughts are of crypto and crypto stocks? ADA took a huge dive, wondering if it will be a good price to start getting into. Let's take a look. ADA. Let's see here. These futures contracts. Let's see. What's a good one?
Yep, that one. Yeah.
That one. Yeah. There we go. Oh yeah, that's what I call a dive. So this is a fairly inexpensive coin, trading currently at about 0.27 cents per coin. Now, do remember, crypto's trading 24/7, which is why it's still moving, and our other securities are not. So this one's taking kind of a bit of a dump here. I haven't looked at Bitcoin in forever. Let's check Bitcoin here real quick, just to get an idea of how the market is. Oop, not that. Sorry. We'll just go with. Yep, there we go. Okay, so yeah, Bitcoin has been pushing up a little bit as of late, but in a bit of a downtrend since we hit about 31,000 here. So let's go back to ADA and we can talk about that. I missed it. There we go. So yeah, Riz, what are your thoughts on crypto at this point?
Garbage.
Yeah, that's my opinion.
Sorry, Larry. No, I mean garbage. Uh, I, I can't. I'm not gonna spend another half an hour, 10 minutes going on as to what the fiasco is going on with crypto. The allegations brought forward against Binance stopping withdrawals and deposits in the US. We have the Coinbase fiasco. I've been following that closely. Actually, management is absolutely incompetent. And I mean, I ain't going to go into it. It just boiled my blood with the amount of money that's evaporated. Yeah, people risk their money. Yeah, people wanted to make it rich. But if you really think about it, the vast majority of crypto projects, whether it's ADA, whether it's fuck anything in between, whether it's FTX fiasco, whether it's all these regional banks with exposure to crypto, whether it's Luna and Terra and all the scamming that went on. It's crazy with it's just one thing after another: erosion of capital, destruction of trust, lack of regulation, lack of clarity, and eventually a lot of disingenuous people, a lot of scummy people trying to make money off the masses. That's really what it is. We saw that with, I can't believe the amount of money some of these people had access to, but they're absolute dimwits. Like, I feel like they have less brain cells than two rocks rubbing together. So I feel like I don't mince my words. I don't mince my words, but I choose it very carefully. And when I say that I'm not a fan of crypto, this is coming from someone who's not. I don't hate crypto. I just not a fan of it. I don't feel like it's worth my time. I don't feel like it should be worth um, expounding upon too much. If someone really is a diehard, they love it. They feel like this is their generational ticket to wealth or something that they really believe in. Fine, go ahead. That's fine. But anytime I look at especially these smaller coins, whether it's Cardano, whether anything, I'm just like so off put by it. It's like an absolute, uh, uh, I don't know what the right word is, but really it's like,
Dumpster fire.
yeah, that too. Let's say buzzkill. It's a huge buzzkill. Um, but yeah, again, Larry, just with all due respect, it's just a cap. I'd rather buy a couple of shares of something else that's trash.
Well, there you have it. That's Riz's feelings. I mean, if you look back, there's a reason I zoomed out here, just to kind of give you an idea where this thing has been. I don't see this thing running back to 2.5 anytime soon. So, in the grand scheme of thing, this move is not too spectacular. I would steer clear of it as well. It looks kind of like a shit coin. But yeah, I would take. I would not. If you're going to take a position, make it really small and just resign yourself to the fact that you may never see that money again. So if you want to do that, feel free. We're not going to tell you to stop, but we cannot really endorse that type of a move. But hey, it could work out for you, but it could also evaporate into thin air as well. All right, Jeff has a question. He says, with respect to the rally, of course, he's referring to the SPX rally that we were talking about here just a second ago. He says he's having a hard time taking full-size positions or entering positions at all, looking into next week with the rate decision. He would like to know how you, Riz, approach trades in this kind of a market environment. That's a great question.
Great question, Jeff. You're very much on point, and I kind of echo your sentiment. I too feel that way. Like, if I do take trades, depending on what they are, if I'm shorting a crappy Chinese stock to the ground, then yeah, I might take a little bit more risk. But generally speaking, even the long positions in solid companies, they're not too large, because I'm kind of biding my time. We have periods where you don't want to get ahead of yourself and get ahead of the market. So you got to let the market come to you. I'm of that, you know, thought process that I feel like the market a little bit lower. We aren't, oh my God, okay, this is it, and now we're going to see all-time highs and highs and highs. Again, it could be wrong, but I think we do have a few more shoots, so to speak. So that's my thesis, and because my thesis is that it would not be prudent of me to buy oversized positions, to buy everything left and right, right? Now, if someone feels opposite, they feel like, well, this is it. We're in a bull market, and this is a sustained bull market. then for them, based on their thesis, it would make sense to actually take more positions, take larger positions, have more exposure to the long side, right? So based on what you said, Jeff, you and I have a similar thesis, right? Just solely based on what you said. So that's okay. That's okay. It goes, both ways. Maybe in the next 3 years, we're looking back, and maybe we're on a webinar and when we look back, we're like, yeah, okay, thank God we didn't take too many positions. Thank God we actually took smaller positions when we did. And thank God we had a cash reserve because this is now another opportunity to buy, right? Whereas the people that thought, okay, to the moon, they're going to be in the opposite camp where they're going to be thinking, I wish I didn't buy so much, or I wish I had capital left over. I wish I, kind of waited and let the market come to me instead of FOMOing and chasing. Who knows, right? So I find it fascinating how you can speak to two people, um, even in the same circle, even in the same group, even in the same uh, household, even, and they can have two differing opinions on everything. That could be politics, markets, everything. So, this situation is no different. I do concur. I do relate. I'm in a similar boat, and I don't think it's wrong. I don't think it's wrong. And as far as how I approach it, I approach it very calculatingly and very, I would say, in a disciplined manner where I only take, because I've done this for long enough, uh, I only take what I'm okay with uh, going to sleep and not worrying about at night. So if I buy ABC company, I buy knowing that if the market goes down another 5% tomorrow, I stand by that. I'm okay with that. I'm okay with that company also going down maybe 5, 10% because that's the chance I take. I'm okay with that. On the flip side, if the market goes up 2, 3, 5%, that's fine. That's great because I'm long. Uh, but if I can't stomach that process where I feel like, okay, if I'm buying X amount of dollars of this company stock and the market drops 5% and this thing could drop 10% in that same time frame, I'm not comfortable that I don't take that. Could be anything. Could be Microsoft, Apple, anything. So that's the way I really kind of filter my decision making in times like these. It's not just, people are like, oh yeah, have a screener and have a trading plan. That's great. Trading plans are fantastic. But some of this stuff, as you get more experience and more time in the markets, some of it is a little bit more free flowing. And that's just one example I've shown right here.
Awesome insights. I don't think I could have said it better myself. It really is a very there's a lot of trepidation right now is the best way I can say it. There's a lot of conflicting data, in my opinion. That's the market seems rather euphoric lately, but yet there's a lot of indication that there may be more downside. And so I think taking a more cautious approach, not chasing, is really the best way to go in this market right now, with so much uncertainty and things being so volatile. Around the world, there's so many potential external catalysts that could happen. That could really throttle the market in either direction. It's so tricky right now, and being a more cautious trader is a good way to make sure that you don't unnecessarily lose trading capital due to overtrading. So, really great insight there. Riz, thanks for coming back on. I'm glad you're feeling better. Glad we're back at it again, and it was a pleasure having you on the webinar as always.
Yeah, thanks for having me. It's good, recovering slow but steady. I want to be back. It's something that's important to me. And of course, I've been an elite. I pretty much the first thing I did was look at the markets the moment I came out of the operating room and got up in the recovery room. That's the honest to God truth. And you guys know some of the trades I've placed already in elite. So yeah, I really had maybe a couple of days off, so to speak. Um, and then after that, it was really back to the races. And yeah, it's good. It's something I am glad to do. I enjoy and passionate. It's not easy. It's not a cakewalk, but I wouldn't have it any other way.
Pleasure is all ours, and it's great to be back. Great to be back at it, and I can confirm that Riz was looking at the market after he came off the table. I have no doubt about that because he was messaging us rather after he got out and be like, "Hey, what's going on in the market?" So. Guys, thank you everybody for coming out. Thank you for all of our YouTube subscribers. Make sure you comment down below what gas price you're seeing so we can kind of compare and contrast what we're seeing in our neck of the woods. And we'll see you back in the market on Monday.